over to you.
Thank you, Chris.
Woo!
Woohoo! Yeah.
You want to give him 2 claps for Ric Flair just to get started? Yeah. All right, 2 claps for Ric Flair.
Woo! Thank you. Thank you very much. I'm excited to be here. And thank you, Chris, for gathering your people, and thank you for your attention. I appreciate it. My name is Adam Hefner. I'm with First Rate Financial. I flew all the way from the great state of Alaska to be with you here today. I've got a handful of my team members with me. There's Justin, the big guy in the back. Then we've got Kristen and Amber, just drove in from Wyoming. Recently imported from Germany, actually. And there is Bree, and Tiffany is right here up in front and center. I like smart kids sit up front, so kudos to all of you guys. This is a brand new slide for us. 20 years in business. We are celebrating our 20th birthday, 20th anniversary, whatever you want to call it this year. And we're proud about that. So we're going to celebrate our success. And it's been a weird 20 years. It's been a bunch of weird things that have happened, ups and downs in the market. As Chris pointed out, it's important to educate yourself, and so that's what we're going to do here today, all right? Before we get into the topic and what we're really going to get into, a little bit more about me. This is my beautiful family. It's my wife, Jessica, and my 2 daughters, Elsa and Ava. They are 8 and 11. They are my son and my stars. I was just skiing and snowboarding with my oldest, Elsa, up in Alaska just on Saturday. So we like to have a lot of fun and play and adventure together. Born and raised in Alaska. I bought my first fourplex when I was too young to know any better, so I got into investing young. I've been doing mortgages since the early 2000s, grew my personal production to be the top 1% in the nation, became an owner of First Rate Financial in 2018. I've done a handful of flips, got into flips. Flips got me into hard money lending, so I've done a bunch of different kinds of investing from a bunch of different angles. I do own some property here in Denver. I am a landlord actively, both in Colorado and in Alaska. About to have my second Denver property. So my partner Justin, and we have a third partner, Jason. The 3 of us are all owners in First Rate, and we're flipping properties right here in Colorado and in Denver. So we just had an offer accepted on a property yesterday. We're doing our inspection later today. It's going down. So we're committed to this market. We love being here. Denver's special to me. I asked my wife to marry me 17 years ago in Denver, and we danced the night away at Red Rocks, seeing Zach Brown Band, and we spent a lot of time here over the years. So we love Colorado. It's very similar to Alaska.
Are you a Swiftie?
You know, I'm pro Swiftie, but I'm not a Swiftie myself necessarily. But she's a pretty amazing woman. All right. So what we are going to do today is we're going to talk about what's going on in the market, some expectations. What we're not going to do today. What we're not going to do today is make any predictions, okay? There's been a lot of people that have made predictions over the past couple of years about when interest rates are going to come down, when the tailwind that we've had for the past 10 or 15 years is going to come back. And all of those predictions have been wrong. All of the time periods, all of the indicators have come and gone, and we've not gotten what we expected out of the market or with interest rates yet. So no predictions. Okay? What we are going to do is educate ourselves and learn about some of the fundamental mechanics of the economy, of interest rates, of mortgage loans, and how they impact you and a home buyer today. Okay? As human beings, I think that we tend to be afraid of things that we don't fully understand. And that starts at a very young age when we are scared of the dark. We're scared of the closet. We're scared of the pile of clothes that looks like a monster. And if we can't fully see and understand what's in the closet, our mind races to the worst possible scenario, which is that thing's going to come alive and eat me. And so we're going to attempt to dispel some of maybe your own fear or your client's fear by understanding the forces at play, all right? And after we understand some of those forces, those economic mechanics, we'll be better able to keep our eye on the market, our finger on the pulse, and anticipate what's coming next, if not predict when that will happen. You guys with me? This is not a 101 class. I know you guys are pros, so we got pro level material. What that means is I want your engagement and involvement because some of this can be a little bit dense. I'm going to try to make it as digestible as possible, but please interrupt me, shout out a question, raise a hand. I want to make sure that you guys are tracking all of this because I really think it's important as you as professionals to be the educators for your clients, all right? Nothing smells worse than commission breath on an all-commission salesperson, all right? And so I don't want you to be out there heavy breathing on people with your commission breath. I don't want you to be out there protecting, educating the market and the community and the people we serve. You guys with me on that? Okay. Real quick, before we pass this slide, a couple of the specific key metrics that we have been told to watch over the past couple of years in the mortgage and real estate world of when rates will come down is the federal funds rate and inflation numbers. Both of those metrics have meaningfully improved in the past handful of months, yet we've not seen interest rates improve. And so we're going to go through maybe why those are not the best things to watch going forward. As we start the journey, I want to look at what it feels like to be a home buyer in America today. So here is the jump in interest rates we've seen. In 2021, January, rates were below 3%. January of this year, they're almost 7%. This is one of the fastest jumps in interest rates that we've seen in recent memory, all right? This is what it feels like when you start crunching numbers. The home price of $420 is the median home price in America. I know that home prices might be a little bit higher than that down here. Good news. If you put 20% down on a 30-year fixed rate mortgage, your monthly payment at 2.75 is $1,300. At the current interest rates, you're looking at an increase of almost $900 per month, which is substantial, right? The total amount of interest paid over the lifetime of the loan goes up from $157 to more than the purchase price of the house. Right? You bought that building for $420, you pay $460 in interest over the lifetime of the loan is demoralizing, if nothing else. If you look at the total out-of-pocket expense to buy that property and pay off your loan, hold it to term, the total cost jumps from $578 up to almost $890,000. What this means is it's just less joyful, it's less fun to be in the market to buy a home today. Also, should be noted, the $420 purchase price. Does $420,000 buy you the same property today that it did back in 2021? No, right? It's a smaller home, it's a less desirable home. And so if we look at just the numbers, apples to apples on the financed dollars and the purchase price, it doesn't tell the whole story that that purchase price doesn't buy the same property that it did just a few short years ago. How did we get here? All right, how did all of this happen? Right? We've had a tailwind in the real estate and mortgage industry for the past 10 to 15 years. And so what happened? What broke that running streak that we were on? It all started with quantitative easing. Has anyone ever heard that term before? You guys familiar with that? A few of you guys? Good. I like it. We've got some economic nerds out there.
Ben Bernanke was all about it.
There you go. Yeah, Ben Bernanke. And so quantitative easing, the technical definition, is when the central bank starts printing money to stimulate the economy, all right? Here's the analogy that I want us to roll with for this presentation. If the economy is a plant that isn't growing well, quantitative easing is like watering it to help it grow. But if you water it too much, it could make a mess, like causing inflation or higher prices, and so it has to be done carefully. You guys with me? I saw an app for your iPhone, speaking of iPhone apps, saw an app for your iPhone where you can take a picture of your house plant and it will analyze the image and tell you whether your plant is suffering because it doesn't have enough water or whether you've overwatered it. Have you seen this app? It's pretty cool. Plant ID, it's pretty cool, right? And it's because for some of us, it's hard to tell why my plant is suffering, right? I've been watering it, I've been diligent, I'm paying attention to it, why is it suffering? And it can be hard to know whether it's a house plant or the entire United States economy, why is it suffering and what does it need, all right? So quantitative easing, Ben Bernanke brought that to us, and it has to be done carefully. Quantitative easing, we started to really meaningfully play with in America for the first time back in 2008. Who was selling real estate back in 2008? Sweet. We got some freshies in the group. I like it. Back in 2008 was the Great Recession, the great housing collapse of 2008, 2009. It was a big deal, all right? And this economic collapse threatened to destroy our economy and then become systemic and bleed into the world economy. It was a major issue. And you can think of it as the house plant dying, right? Our house plant was sick. Our economy was sick and needed help. And so Ben, in all of his wisdom, him and the gang, they got together and they said, how about we start printing money to water the economy, all right? They came up with this bold, exciting new plan and they budgeted $600 billion, which seemed to be a lot of money. They dumped that $600 billion into the economy and that dry soil just soaked it right up and immediately it was not enough money. So they expanded the program, they took it up, they increased the budget to $1.75 trillion. which they dumped into the economy, and then that dry soil just soaked it all right back up again. So then a few months later, now we're in November of 2010, they budgeted another $600 billion. And then not long after that, they did a third round, and they said, we're going to stop naming these rather than QE 1, 2, and 3 because people are keeping track of all these things. We're just going to allow ourselves to print money indefinitely. QE infinity, quantitative easing infinity to the moon. And we'll just continue to print money to water the dry soil of our economy anytime that we deem that necessary, right? A tremendous amount of money. And then in 2020 is COVID. 2020 unleashed the largest flood of federal money into the U.S. economy in recorded history. Over $5 trillion was dumped into the economy. That's where it all went to. I found the first bullet points pretty easily. That other category of $288 billion seemed to be a pretty large bucket of others. So I had to dig a little bit deeper to figure out that a chunk of that went to the airlines, right? This image then on the PowerPoint is a very real historical picture of the Federal Reserve overwatering our economy. And before you know it, the plant was no longer suffering because it was dry. It was suffering because we drowned it in water and it was like suffocating, right? The rots were rooting underneath the soil that you couldn't see. And the thing that we needed, the thing that was going to help us survive and come out of this really rocky time in 2008, 2009 became toxic. Good news, it worked until it didn't, okay? So we got a graph here. This starts in October of 2008. Interest rates up here in the top left-hand corner are 6.5%. You can see that all of that money that we were printing and spending into the economy, a bunch of that went into specifically to lower interest rates. Lower interest rates to help push and fuel the economy. And we'll get into more exactly how that works. But you can see it in the picture. Picture's worth 1,000 words. Every time interest rates started to climb back up again, the Federal Reserve would just smack it with another $100 billion to keep interest rates lower. You'll notice that there's a couple gray bars. See the gray bar over there? The gray bars are recessions in the U.S. economy. There is one right here. You just can't see the other side of it. All the graphs come directly from the Federal Reserve, so it's like legit data. And we'll be paying attention to some of those gray bars or the recessions over time. So 2008, that was the Great Housing Collapse recession. The one on the further side, that is the COVID recession. Look what happened to interest rates right after the COVID recession. They went down to the lowest point in the history of our nation. It should be pointed out then that the reason their interest rates got well below 3% is not because they naturally belong there. This isn't a natural or normal thing to have interest rates that low. Even below 5% isn't natural or normal in a historical sense. It's because we have very much been buying these interest rates down. It's because the tampering of the federal government and Ben and the crew and all of this printing of billions and trillions of dollars. And it worked until it didn't, and eventually we hit rock bottom. We hit rock bottom, and then interest rates exploded. That's the same graph that we started with. All right, so why? When did the money that we were using to fuel the economy, when did that become toxic, right? This is an image of inflation, and inflation there's a couple different ways to look at it and to measure it. Inflation's measured at different stages in the economy. What we're looking at here is the effect that inflation has on the stacking of prices over time, all right? I want you to think of inflation as growth. And healthy growth is good. If my plant is growing, then it's healthy. If my two beautiful daughters are growing at a certain rate, a healthy rate, then that's normal, expected, and that's what I can measure, right? I can see if I'm on track. The goal for the United States economy of the Federal Reserve is to grow between 1% and 3% per year, with 2% being right in the middle. That'd be the ideal target. So that growth rate or inflation rate, to think about it that way, ideally is 2%. And so if we look back in time, we can see that 2% growth, 2%, 2%, 2%, 2% over time creates a nice stable trajectory of price growth over time. And you can see that right after COVID, that gray recession line there, we took on a whole new angle of attack. And so now we were growing at an unhealthy rate, right? It's out of control, right? This is important for us all to visualize because somebody somewhere is saying, I'm going to wait for prices to come down. Whether that's home prices, car prices, prices of anything else you got your eye on, wait for prices to come down. That's not how inflation works. That's not how growth works, right? If your plant stops growing and starts shrinking, it's indicative of a problem. If my beautiful daughters stopped growing and started shrinking, that would be a problem. Coke used to be a nickel, and it's never been a nickel since. Coke didn't go from a nickel to a dime and then back to a nickel, right? We can see that on our price trajectory and growth over time. This is natural and normal. Prices aren't expected to go down. The other thing to note, if we look at this angle of trajectory, is that the farther this higher rate of inflation goes before we get it under control, the worse it is and the harder it is to solve down the road. The harder it is to get the genie back in the bottle, all right? So if you were to draw this line out further, this projected line comes out this way, and then you look at this trajectory here, the farther we get in time, the bigger the gap, right? The bigger we get in the gap between where we are and where we should have been, the more pain it creates in the world and in our economy. The other problem with inflation that we'll get into is it increases the gap between have and have-nots. And the farther we get down the road, again, the harder it is to solve that problem. Here's another way of looking at inflation. This is a graph that shows the rate of change over time. So this looks at where is inflation today versus where was it last year. If you look at the rate of inflation coming into COVID, so this is just right before the COVID recession, inflation was at 2%. The growth was at 2%, which is spot on. That's perfect, right? That's exactly where we want it to be. Right after COVID, the rate of inflation dropped down to the low end of the expected scale, so all the way down to 1%. That's because the economy was rocky. We weren't sure whether we were going to live or die. Shelter in place, stay at home, don't go to work, right? Then we can see that in early 2021, we had a giant spike in inflation, and we went from the low end of the expected range to just above the high end of that expected range. So inflation's just over 3%, and a bunch of people who were watching and measuring the growth of the house plant of the economy started to panic. They said, whoa, this is a major problem, the likes of which we've not seen since the 70s. Back in the 70s was the last time that our economy really dealt with inflation in a meaningful way. And so they panicked. And the Federal Reserve and a bunch of other people in the government, they came out and they were all over the news, very publicly, wringing their hands and telling the American public, don't worry, this is not the inflation you're looking for. This is transitory inflation. This is the war in Ukraine, it's supply chain issues, this is oil prices, lumber prices, steel prices. Don't worry about it, it's all gonna go back to normal once normal comes back, right? We believed them for a minute and inflation went down. Look, they were right, and then boom, it exploded to the highest point that we've seen inflation really in a generation or so. Also, I want to draw your attention to the little red arrow at the top. The graph we're looking at is the Consumer Price Index, or the CPI. This strips out food, energy, and shelter. Have you guys seen the prices of food, energy, and shelter increase over the past couple of years?
Yes.
Yeah.
I sure have, right? You could say that food, energy, and shelter are some of the biggest increases in cost that we've seen. And so if you add those back in, you get into what I like to call the real felt inflation, or the RFI index. And what that is that if you're living in this world, right, you're an American consumer, that your actual real felt inflation is more like 8 or 9% or higher, which is scary to think about. That means that the money that you have in your bank, in your checking account, in a Folgers can buried in the backyard is going down in value at almost 10% per year just sitting there. And so even if you're a diligent saver, you can't save your way out of this mess, right? Which is scary to think about. All right, never fear, the Fed is here, right? So they're gonna come bail us out. It's the Federal Reserve's job to manage inflation, control the economy, right? This is one of their biggest callings. Their job is to manage the inflation of our US economy. The tool that they do that with is the federal funds rate. So we have a new line on the graph. We have the federal funds rate going into COVID was right at 1.5%. During COVID and right after, they dropped the federal funds rate down to 0 to to further growth in the economy, to help fix the plant that was dying, and we're going to get more into what the federal funds rate is, don't worry, but they dropped it down to 0. And then during this transitory inflation period, they said, hey guys, this is not real inflation. We don't need to do anything about it, and you don't need to worry about it either. We're going to keep the federal funds rate at 0. Not until halfway through 2022 did they start to take the federal funds rate up in response to the inflation that had exploded in our economy. And good news, it worked. So if we look at the graphs, we can see that as the federal funds rate goes up, the rate of inflation comes down, and relatively quickly. And so pretty soon we found ourselves with inflation back at the high end of normal, flirting with that 3% line. And so the Federal Reserve starts to lower the federal funds rate. You can see that green line most recently is trending downwards. Also look most recently at that line of inflation, which is trending downwards most recently. So then if we layer in the 30-year fixed rate mortgage, we look at what are rates doing, surely, because these are the two metrics we've been looking at, we'll see that interest rates go down. But then frustratingly, they're doing the exact opposite. And so if you have been paying attention and reading all the blogs and the mortgage news articles and the economic what have yous, we should have been celebrating right now as interest rates were coming down with the rate of inflation and down with the federal funds rate. And what we're seeing here on the graph is it's doing the exact opposite. What in the world, right? What in the world? WTF, okay? So if the federal funds rate is coming down and inflation's coming down, why haven't we got what we have been waiting for, wanting, wishing, hoping was going to happen next? There's a couple things that we need to understand, right? And again, a lot of predictions have been made around the federal funds rate, the rate of inflation. We're not going to make any predictions. They've all proven to be wrong. I think that those predictions lead to bad expectations from consumers and from professionals. And as we have bad or false expectations or anticipations of where the market's going, it leads us to advise our clients in a way that's not helpful or healthy for them, right? Because it puts us all in a holding pattern of waiting. I'm going to wait until next May. I'll wait until next July. I'll wait until the end of the year. I'm going to wait until interest rates will be better next spring, right? And we're all sitting around in this holding pattern. It's not helping anybody. These are the two economic forces that we're going to be learning about today and measuring. The first of which is the federal funds rate, which we've been talking about. But what is it really? How does it work? And how does it affect the economy? And then mortgage-backed securities, or MBS. The first is the federal funds rate. This is the definition of the federal funds rate, textbook definition, the interest rate that banks charge each other to borrow money overnight. If you talk to your mortgage pro, if you talk to an economic expert and you ask them, what is the federal funds rate? This is most likely the definition that you get because that's what it is. But the definition doesn't help explain the thing at all. Why are they borrowing money overnight? What even is that? What does that mean, right? Well, the federal funds rate and that overnight rate the banks borrow money from each other is necessary because of the fractional banking system and its required reserves. Does that help clarify things for you at all? Not really, it doesn't, right? It doesn't. Has anyone ever heard of the fractional banking system before? Has anyone ever heard that? A couple of us, cool. It's kind of a cool and a little bit scary thing, all right? Let's look at it. A picture's worth 1,000 words. This is how the fractional banking system works in America and where that federal funds rate comes into play and how it helps control inflation, as we looked at that a moment ago. Here's how it works. Excuse me. This guy's got $1,000. He puts his $1,000 into the bank. The fractional reserve banking system says that the bank must keep in reserves 10% of that depositor's money. So when you put your money in the bank, they don't keep your money around for you. They only keep 10% of it, and the other 90% they lend out to someone else. That's how banks make their money, okay? So diligently and in accordance with the required reserves, they're going to keep $100 of this guy's money in the bank vault, available for his withdrawal. The other $900 they're going to loan to guy number 2 over there. This guy's got $1,000 in the bank. This guy's got $900 in his pocket. There's now $1,900 in the banking system, and the bank's actually only got $100 in real money in the bank. This guy with his newfound $900, he goes and puts his $900 into the bank. They diligently keep 10% in reserve. They make a loan for $800 to this guy over here. That guy at the top's got $1,000 in the bank. He's got $900 in the bank. This guy's got $800 in his pocket. There's now $2,700 in the economic system. The bank's only got $190. It happens again. So that guy puts his money into the bank. The bank reserves how much? 10%, $81, a loan of $700 to this guy. Now there's over $3,400 in the economy, and there's only $270 securing all of that cash. How does that make you feel?
It's me wondering about Fort Knox.
Where's the gold? Is it really there?
What a photo yesterday, all the eggs are there, no gold.
Yeah, right? What are we going to find? And so this is the infinite money glitch that is the U.S. economy. This is what keeps us ahead of everyone else. This is what fuels the engine that is our economy. It's also a little bit terrifying to look at. It's a little bit scary as you recognize that this is kind of all of a house of cards. Do you guys remember a couple years ago when Silicon Valley Bank and Signature Bank exploded overnight? This is a big piece of what happened and why. We'll touch on that a little bit later, but this is what was going on there. I've seen differing statistics. You got to be careful where you get your data, but somewhere between 80 and 90 cents out of every dollar in our U.S. economy is debt. It's not real money. It's this right here, right?
It seems like a Ponzi scheme, but like an exponentially worse Ponzi scheme.
It sure does. It sure does, right? And it's terrifying to think about. And all of a sudden you start worrying, how safe is my money really, right? How safe is it really? Because you recognize that like even this guy up here, he's got $1,000 in the bank. He's got more money than anyone else. But even if he showed up to get his money, they don't have his money. Even the guy who's got the least amount of money. If the guy has got the least amount of money in the bank, he says, I want all 800 of my dollars today, the bank doesn't have the money to give him, which is kind of crazy. Okay, the overnight rate at which banks borrow money from each other. That's the federal funds rate. Why do they borrow money overnight from one another? This is why. So the fractional banking system says that at the close of business, this bank has to have $270 in the bank to secure 10% of all of those individuals' deposits. Throughout the normal course of doing business, the bank may have more or less than this reserve requirement. So if this bank, as an example, they close for business and they've only got $200 in the bank, they're short funds and they need to borrow money overnight to shore up those requirements of those required reserve assets to protect their depositors. You guys with me? What's the rate that they pay to borrow the money overnight? The federal funds rate, right? You might have heard the term banking hours or banker's hours at some point in time. Banker's hours started because a long time ago, the banks used to close their doors to the public at 3 o'clock p.m. And they would use the last 2 hours of the day to balance their books. Right? They'd say how much money did we take in deposits, how many did we give out in withdrawals, and how short are we on the reserve requirement. And then they would find another bank who had an excess of reserves to borrow that money overnight. Then they'd all get to go home. They come in the next morning, they open the doors, they give the money back to where they borrowed it from, and then they go about their day. So the federal funds rate affects the daily cost of doing business for the banks. You guys with me here? Every single day, Monday, Tuesday, Wednesday, they're pushing money around to all the different banks in the system and they're paying that federal funds rate. So when the federal funds rate is high, the cost of doing business is high for the banks. When the federal funds rate is low, it's easier and cheaper to do business for the banks. We saw during COVID that the federal funds rate was dropped down to 0. Remember that slide? Why did they do that? It's because the plant was too dry. Right? The plant was dying, the house plant that is our economy. It needed to be watered. And so not only were they printing money, but they dropped the federal funds rate to 0. And so now the daily cost of business to the banks has gone down to essentially nothing. One of their biggest expenses has gone down to 0. And so what that does is it speeds up this cycle. If it's cheaper for the banks to do business, then they're more incentivized to give loans. And they can offer cheaper loans to consumers because their cost of business is lower. They pass those savings along. It's cheaper to go buy a new car, a new snow machine, a new truck, a new trailer, a new toy, a new whatever, right? And so as consumers do, and we're a consumer-driven economy, we consume more. When rates are low, we're borrowing more money. And so this whips into high speed. And then when it got too frothy, when inflation was happening and the rate of growth was too big, what did they do with the federal funds rate? 0% up to 5.5%. And they slammed that sucker, right? What that does is the cost of doing business, which was essentially nothing, gets real expensive real fast. And so the banks who feel that immediate pain, they day one pass it along to their consumers. Rates have gone up. And so people buy new cars at a lower rate, and they buy new things at a lower rate. We're less likely to consume, to spend, to borrow. Does that make sense? The federal funds rate then acts as a lever for the economy. If they want it to go faster, they want to accelerate, they put it down and it floods cash into the system as this thing whips into high speed. And then as they want to suck cash out of the system, they try to dry out the soil because it was oversaturated. They pull that lever back and this process slows down. And we're generating cash slower and it decreases that rate of growth or the rate of inflation. You guys following me? Okay. It's kind of cool, isn't it? You guys like that graphic?
It's awesome.
It's kind of cool. I made an excited sound when I found it and shamelessly swiped it off the internet. I was like, oh man, that's super cool. All right, to recap on the federal funds rate, it affects the cost of doing business for banks. It directly impacts the rate on consumer loans like auto loans, lines of credit, etc. Acts as a lever for the Fed to flow money in and out of the economic system. It is the Fed's primary tool for managing inflation. The next big economic force that I want to talk about is how mortgages and MBS are born. MBSs are mortgage-backed securities, okay? A security is an investment. That's really all it is. You can buy stocks, bonds, those are securities. So a mortgage-backed security is just an investment where the interest comes from mortgages. It's an investment backed by mortgages. You guys with me? Okay. Here's how it works. We got this guy in blue over here. He wants to buy a new home. He goes to the bank qualifies him. They look at his credit, income, assets, and say, all right, you're approved. Blue guy gets a loan. The bank then has manufactured a mortgage. They're going to manufacture a bunch of additional mortgages, all in similar size, shape, and color. They package those, bundle them up into mortgage-backed securities, and then they sell those to investors on Wall Street, okay? You guys can buy them too. Investors can buy them, you guys can buy them. You can go buy a mortgage-backed security today. The price that investors are willing to pay for the mortgage-backed securities plays a direct role in the interest rates offered to consumers. Here's how you think about this. This is oversimplified a little bit. If the bank offers 5% mortgages to the guy in blue, 5% mortgages, they get a whole bunch of 5% mortgages. Now I have a 5% yield on my mortgage-backed securities. You as an investor can go invest in a mortgage-backed securities, also referred to as a bond. So if you hear me use the word bond, MBSs, back and forth, okay? The investors get 5%. If the investors buy all of the 5% mortgages and they still want more, they're asking the bank, can you get us more? And the bank says, we did all the loans we could at 5%. We're sold out of 5% mortgage-backed securities. Then the bank says, hey, investors, would you buy 4% mortgage-backed securities? I bet I could do more loans at 4%. The investors say, sure. All of a sudden, the next guy in line to get a mortgage loan, he's offered a 4% rate. All the 4% mortgage bonds, mortgage-backed securities, they sell out immediately as well. The bank goes back and they're like, this is exciting, 3% rates for everybody. They manufacture a bunch of 3% mortgage-backed securities. They go offer them to the Wall Street guys. The Wall Street guys say, no, thank you. We don't want 3%. We are good at 5, we're good at 4, but 3% in this market, this economy, with inflation where it's at, 3% is not enough of a rate of return. No, thank you. So then when the bank does another loan for another home buyer, are they getting a 3% rate? No, they're not, right? They have to increase the rate to the consumer because of the price the investors will pay on the back end. So the way to think about this is the yield to the investor equals the interest rate to the borrower. If there's high demand, it means lower interest rates. If there's not very much demand, then they have to charge that home buyer a higher rate so they can offer a higher yield. You guys following? Here is a picture of the mortgage-backed security market. So your mortgage pros We're watching this all day long to see what's going on with interest rates today. This is what we've got our eye on. If you look back over here, this goes all the way back to 2020. Notice how prices were relatively stable and relatively high, all right? Prices are both stable and high because of all of those trillions of dollars that were printed by Ben and the crew that were floating around in the economy since the great housing collapse of 08, 09. One of the major places where they were shoving that cash was into the bond market to keep interest rates low, to make us feel comfortable investing in the American housing market because we had shaken the faith of American home buyers and investors during that period, right? Just because it's interesting, these MBSs, did everyone ever see the movie The Big Short? So during that time period in the movie, it's a great movie, they talk about how these MBSs, these mortgage-backed securities, became toxic assets because we were doing crummy loans for people. You didn't need a job, you didn't need a down payment, et cetera, et cetera, et cetera, layered risk, and people stopped paying their mortgage loans and they went into default. As they went into default, the interest that the MBSs were spinning off went away. And so the investors are like, hey, I'm not getting what I was promised. I don't want to buy those anymore. I can't trust them. Right? So the federal government comes in and says, don't worry, guys, we will buy them. We're going to print money and we will buy all of the mortgage-backed securities. We'll buy them all, right? And on any given day, if the price of the mortgage-backed securities was going down, the Federal Reserve steps in, they buy all that was left and they push prices higher. And so since 2008, 2009, the Federal Reserve has been the biggest buyer of mortgage bonds or MBSs in the market. They are the number one consumer of this thing. And it's a thing that they didn't buy at all before 2008, 2009, and QE. And so they have very much been tampering with this market for many, 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 many years, keeping prices high and stable. Until January of 2022, which is when inflation exploded. And when inflation exploded, they had to take a hard look in the mirror and say, all right, we were probably the biggest part of this problem in all that money that we are printing, keeping the federal funds rate low and keeping that fractional reserve system spinning at a high speed, right? Keeping mortgage rates artificially low, 4%, 5%, 3% and lower, right? And so all of a sudden they decided they had to undo all of the mess they'd made. And right here is where they stopped buying mortgage-backed securities. So the biggest buyer in the market just stopped overnight and prices collapsed. Not only because there was significantly less demand, but because it scared the snot out of anyone else that was investing in this market. If you were an investor previously, you were pumped on this market because anytime the price of the assets went down, the Federal Reserve is right there to buy the rest of them and push the value higher, right? So now everyone's freaked out. Right in the middle of this then is when the Federal Reserve decided to start unraveling their balance sheet, which is technical jargon for they started selling all of the mortgage-backed securities that they'd been buying. So the past decade and a half, they're spending trillions and trillions of dollars buying these things, and all of a sudden they're flooding the market when everyone's scared and everyone's spooked and prices go down, 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 down. This is 2.75% on your mortgage rate, and this is that's 8% down there. Overnight it happened that fast. Mortgage-backed securities. Wrapping this up real quick. Bundles of mortgages sold on Wall Street. Inflation erodes the value of any long-term fixed rate investment. We didn't really get into this, but here's how this works. If I'm going to invest my money into a mortgage-backed security, it's a long-term fixed rate investment, 30-year fixed rate mortgage. If interest rates to consumers are 5%, I buy a 5% MBS, then I'm getting a 5% yield. If inflation is where it should be at 2%, then I'm stoked on my 3% that I get to keep. I earn at 5, I'm losing at 2, I keep the 3 in the middle. If inflation starts to go to 4%, 5%, 6% or higher, then my 5% yield isn't looking so hot anymore. And I care about the value of my money when I get it back. Because if I park my money for 30 years or longer, it's going to be stuck there. I can't move it. I can't get it back. What is the value of my money when I get my money back? And so I care about the rate of inflation. Not just the rate of inflation today, but where is inflation going? Where's inflation heading? You with me? If inflation is high, investors will demand a higher yield to make up for that.
What happens when the mortgage-backed securities and all those homeowners in that bundle, in that package, package go through huge amounts of refinancing and drop their rate? Does that drop the...
Yeah, so those mortgage-backed securities, they get paid off. And so if you were an investor and you had bought a 30-year fixed rate mortgage package, you get paid back sooner than you'd hoped. And so maybe that's good news, maybe it's bad news, right? And so if interest rates are coming down, and so if I have a 5% yield on my MBS and then rates go down to 3%, I'm stoked at first because I'm still earning at 5 when all of the new bonds are only having a yield of 3. I'm pumped, dude, mine's going up in value. It's worth more than it was, it's appreciating. But then if it gets refinanced and my 5% gets paid off, I get my money back early and I'm like, oh nuts, I gotta do something else with it. If I wanna go back and buy another bond, the new bonds are only giving me a 3% yield, right? Does that make sense?
You're stuck with the cash going, hey, where do I invest?
Where do I put it now? And so then what I'm gonna do is I'm gonna put it back in the bond market, right? And so yeah, it moves up and down. But that's a fantastic question. And so the next, like where your brain should go next is the realization that if I invest into a 30-year MBS, my money's not gonna be tied up for 30 years. Really, it's tied up for like 7 to 10 years because someone's gonna refinance, they're gonna sell the home. No one ever has a mortgage for 30 years, right? Okay. Mortgage prices are inversely related to interest rates offered on new mortgages. MBS prices are inversely related. Pop quiz, just to make sure you guys are all with me still. Why does the federal funds rate directly affect short-term consumer loans while only having an indirect impact on mortgage rates? I'll save you from it. Here's what it comes down to, okay? Here's what I want you to take away. This is your takeaway. The consumer loans are held, the mortgage-backed securities, those mortgage bonds, they're sold. And so the rates to consumers isn't the federal funds rate, it's what will the investors pay for those bonds, right? Do I want those bonds at 5%, 3%, whatever they are today? Do I want to buy them, or is there another better place to park my money? But consumer loans, auto loans and things like that, those are directly affected by the cost of doing business from the banks, the federal funds rate. Chris?
So, I mean, it would almost be safe to say, I hate to make predictions, but from an investor standpoint, the Wall Street guys they don't want to buy mortgage-backed securities at 3%. And if the Federal Reserve doesn't want to buy them at 3%, it's very unlikely that we get interest rates at 3% again.
Ding, 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 ding. Yes, interest rates should have never gotten to 3%. They were only there because the Fed was buying them, right? And the other people that were buying them because the Fed was buying them, right? And where did the money come from to force rates down that low? We printed that money. And we've realized that printing money at that scale is a bad thing. And so what that means is that the water that we were pouring on our dry soil of an economy, we realized it was dangerous and we don't do a good job measuring how much is enough versus too much. And so that means that the Federal Reserve is going to be way less likely to save us in the same way that they've saved us in the past. It was them trying to fix things that screwed up the whole system. And so they have learned their lesson. They won't be doing that again anytime soon. And so don't expect rates to go back down to 3%.
But we've got Doge.
We got Doge, and we'll potentially head in that direction, and we'll get some questions in that area. All right, so this is important because someone soon is going to say to you, I saw that the Federal Reserve is lowering interest rates. I saw that the federal funds rate is coming down. I'm gonna wait till they take it lower, and then I'll get a mortgage. When the federal funds rate went down to 0 during COVID, our phones were blowing up because consumers wanted 0% mortgages. I heard the Fed just took interest rates down to 0. Sign me up, I want 2 of those. But that's not how it works. You guys with me? That's why it's important to recognize that the federal funds rate does not affect mortgage rates. It's the price of the bonds and what the investors will pay for them. All right, so if we are those investors, if we are the investors that buy mortgage-backed securities, at what point in time do we jump back into the market? At what point do we want to buy the bonds at whatever the yield is today? Bond prices are coming down, which means the yield is going up. Interest rates have been going up, right? So when do we jump back in? And what we need to look at is comps. You guys know comps, right? What else could I do with my money? What is a similar investment that yields me a fixed rate of return over time that's about 7 to 10 years in duration before I get my money back? And it is the 10-year treasury. So I can loan my money to the Federal Reserve or to the federal government, more likely. I can loan my money to the government. They'll pay me a rate of return. My money is locked up for 10 years. It's a 10-year promise, and Uncle Sam will pay me interest on that. Interest rates tend to go up and down together. And so when rates are low for borrowing, they're low for earning. If they're high for earning, they're high for borrowing. They kind of go up and down together. Back in 2020, 2021, when I could get a mortgage loan for 2-point-something%, the federal government would have paid me less than 1% to borrow my money. They wouldn't have paid me very much. But if I look at what's going on today, I can loan my money to the federal government and they'll pay me almost 5% with no risk. No risk. Federal government as of, there's nothing wood to knock on, but knock on something, because as of yet, the federal government has never missed a debt payment, all right? They're paying their debt. And so this is a very safe investment. So I talked earlier about how it'd be a bad idea just to have money sitting around when inflation is doing what it's doing. Well, at bare minimum, you could loan it to the government and make almost 5% on your money. You're still not quite keeping up with inflation, but it's a hell of a lot better than nothing, right? If this is the best comp for mortgage-backed securities or mortgage bonds, then let's lay in the average 30-year fixed-rate mortgage interest rate and see how the shape of the two graphs compare. Do they look similar to you guys? Sure do. Looks like they probably follow a pretty similar path. The one thing that I want to note is that the spread, which is the difference between the 10-year treasury and the yield on a 30-year mortgage, compensates the investor for the inherent additional risk. If I can lend my money to the government with no risk at all, if I lend it to a consumer or a group of consumers, there's at least some risk, right? And so the spread compensates investors for that risk. Investors will take it like risky deals, right? We talked about how Justin and I are closing on a new flip property. A flip property is a risky endeavor, right? Maybe we'll make a bunch of money, maybe we'll make a little bit of money, maybe we'll lose a bunch of money. But I'm willing to put my money into a risky investment because I expect an oversized rate of return. That's all that investing is balancing risk and reward. And so the investors look at what the economy is doing today, they look at what inflation is doing today, then they say, how can I predict what's going to happen into the future? And based on what I think will happen in 10 years when I get my money back, that's the spread that I'm going to demand above the risk-free trade that is the 10-year Treasury note. You guys following me here?
Yes.
Why does it change over time? Why does my spread change over time? Because of the expectation of the investors of the role that inflation will play in devaluing their investment. And so back down here, this is a more normal spread. When interest rates were below 3%, a normal spread, 1 to 1.25, that's about right. That's what we'd expect to see. We can see that the spread increased to almost 3% when interest rates were tapping that 8% mark because inflation was out of control in a way that we haven't seen since the 70s, and the investors do not feel that the Fed is doing enough fast enough to get inflation under control to protect their investment long term. Good news, this spread is coming down a little bit, but it still is elevated compared to where it should be, right? So here's some good news, is the realization that the spread is largely psychological. It's convincing the investors that the Fed's really got this. You guys with me? And so as soon as the Fed does a good job of convincing the investors of where interest rates are headed or where inflation is headed more likely, then they're going to say, okay, I feel more comfortable now locking my money up for 10 years with a smaller spread compared to the 10-year Treasury. And so we could get down, we've got at least like a full interest point that we could lower 30-year mortgage rates just by convincing investors that the Fed knows what they're doing. As soon as they accomplish that, and they will eventually, as soon as they accomplish that, then what will happen is investors will demand a smaller yield on the 10-year Treasury, right? And the yield on the 10-year Treasury will come down as expectations of inflation comes down. And so we have some very real opportunity in this market right now to see interest rates improve. The problem is that people have been making predictions about when this was going to happen, and it just hasn't yet. And that's demoralizing. What we've learned so far, the federal funds rate is not the best indicator to watch, as the Fed is slow to react. The U.S. economy is a big ship and it moves slowly. It's slow to react to inputs from the steering wheel, right? Also, the Fed has a history of oversteering. They overcorrect in any one direction. Investors' expectations of future inflation is more relevant to mortgage rates than today's reading, right? Because I'm locking my money up today, I want to know where's inflation going, not what it is today. Also, just as a reminder, interest rates should have never been 3%. It's not normal, it's not healthy, it's not natural. It's because we printed trillions and trillions of dollars and bought it down, and now we're paying the price for our actions. Okay, so we need something better to look at. We need a leading indicator. What is the leading indicator of where we should be having our eyes on of where the economy is headed next? Future inflation.
Jobs.
Bingo. Jobs. I knew you guys were smart. I knew it. Good crowd. All right, so jobs, that's what it comes down to. As we headed into COVID, our economy was super healthy. Inflation was at 2%, federal fund rates at 1.5%. Our economy was like chugging. We were doing it right into COVID. At that time, unemployment was 4.4%. Right now, the unemployment rate is lower than it was even back then, which means our unemployment rate is very low. This is a very low unemployment rate, which is good news. Right? Americans can get and find jobs. And if you have a good job now, you might be able to get a better job if you go shop your skills around, right? You might be able to find a higher wage or a higher salary. So good news, unemployment, low unemployment tells us that the economy is healthy and growing. Fantastic. It's good for Americans. It's good for us. It means more people got more money in their pocket to buy a home. On nuts, though. On nuts. If the economy is healthy and unemployment is low and things are growing, remember the whole problem that we're dealing with is out of control growth. Growth is the problem. Inflation is the problem. And so if unemployment is very low, it means that wage-based inflation, which means wages going up, more people having jobs, people that have jobs making more money, it means we're growing faster, and that's bad news for where inflation is headed tomorrow. Bad news for inflation means that bond yields and mortgage rates will stay elevated, which puts us in the uncomfortable position of wanting unemployment to go up, of wanting, the economy to suffer.
Fire everybody.
And that's he's doing his part, right? You're fired, and you're fired, right? And one of the things that they said during Doge and all of their massive layoffs, and I don't want to make light of the pain that that's creating, but one of the things that they came out and they said is, hey, we are going to increase the size of the labor pool. Increasing the size of the labor pool means that unemployment goes up, and it means that there is a healthier relationship. Like in the real estate world, we look at a buyer's market or a seller's market. Right? Right now, we're in a worker's market where the worker has control to demand a higher wage. And so if we increase the size of the labor pool, it means that the power dynamic between employers and employees is a bit more healthy. You guys with me? So that's one of the things that they talked about. They also talked about how they were lowering demand. And so if you lay off a bunch of people, another way of putting that is decreasing demand because those people don't have jobs, they can't buy things. Right? Yes.
I have a quick question. There was a couple slides that you made me think of it though. It's like around the spread.
Uh-huh.
So there's like temporary buy downs, like 3-2-1s, 2-1s.
Yeah.
One.
Yeah.
So is it the investor of the mortgage-backed security? Are they the ones getting paid that spread with the buy down?
It's a really good question. And so a spread doesn't affect, or excuse me, like a 3-2-1 temporary buy down doesn't affect the investor at all. So
Keeps it flat.
Keeps it flat. And so the way that you fund a temporary buy down, a 3-2-1, is you say, all right, if just to make the math easy, if the payment was going to be $100, and because of the buy down, now it's like $90, like a month, right? I just take that $10 per month and I add that up times all the payments that will be lower. I put that into an escrow account. And that escrow account, just like pays taxes and insurance, that escrow account subsidizes the payment difference. So the buyer is making the $90 payment, but then the escrow account pays the extra 10. The investor's still getting $100 a month. Same to him. So he doesn't care. He's just, his money is even safer because the money's not coming from the buyer, it's in an escrow account. So he doesn't care. Yeah. That's a good question. It's an astute question. Paying attention. I like it. All right, we're going to get into some pictures. This is a picture of the U.S. economy. The U.S. economy is a dude floating in a floaty out in the ocean. Looming just beneath his fingers and toes is the recession shark. Scary looking beast of a monster. In the rescue helicopter, we have the Federal Reserve. The Federal Reserve is dangling the interest raft, the life raft of interest rates. And then they shout on their bullhorn, "We'll check on you next month to see if we need to lower the rate." What's going on here? The story that's being told is that the Federal Reserve is not going to rescue the economy by lowering interest rates until this recession shark has started taking chunks out of that dude. Right? Until he's nibbling at the fingers and toes of the economy, until there's blood in the water, the Federal Reserve isn't going to come back and lower interest rates to save us again because they were too quick to save us in the past. You guys with me? They will succeed in triggering a recession. There is a recession coming. You should not panic. It's not the end of the world. Recessions come, recessions go. But when they trigger a recession, what happens next? What can we predict is on the horizon? Well, mortgage rates will come down because a recession kills growth, right? And if a recession kills growth, unemployment goes up, right? Then it means that rate of inflation, the price stacking goes down, the spread comes down, the 10-year treasury yield comes down, mortgage rates go down. What happens when mortgage rates go down? Home prices go up, right? It's not real hard to see coming. There's a bunch of pent-up demand, is there not, in the home buying market? As soon as rates go down, man, call me back when rates go down. Then I'll buy a house. And everyone's going to rush to the market at once because rates will come down 1%, home prices will skyrocket. We can see it coming. One more picture. Excuse me. This is a picture, it's a story of two different families. We got this guy, Dad, in the greenhouse. Dad's got a wife and two kids. And every morning he wakes up, he gets his coffee, and he whistles a jaunty tune as he goes out into the front yard to climb the ladder and increase the price on his house, to increase the price of his investment, of his fixed asset. He's stoked. Inflation is good news. You got this family on the street. They're tenants. They want to buy a house. They just can't yet because homes are expensive and interest rates are high. And so they got their agent there. And every day they go out there and they look at home prices and they still can't afford something yet. They're a bit dejected. What's going on is that the same economic force is affecting both of those families in very different ways. For the homeowners, inflation is good for them. It makes their home go up in value. We've all seen homeowners get a big bump in prices of their homes, the value of their homes, and their equity positions over the past couple of years. Well, it's made it harder and harder for these tenants to get into a home. Have you guys seen rent go up in the past couple of years? Yeah, rent's going up across the board, everywhere in the country. Rent's going up. It makes it harder and harder, that 8 or 9% real inflation, that's eating these guys alive. There's an opportunity for us as professionals, as a room of intelligent, good-looking professionals. There's an opportunity, as it's our job to teach, to coach, to educate, and instruct these would-be home buyers and teach them how to get into a home. And to teach them that you can't stop inflation. You can't stop some of these economic forces, but you can learn about them and you can use them to your advantage, right? We can learn, educate, and then harness the power of inflation to work for us. Recessions come and recessions go. Again, the gray lines are recessions. This graph goes back all the way to 1964. Recession. Recessions come and they go, and home prices keep on going up, right? They keep on going up. The one but, you're like, but, Adam, there was that one time back in the 2008, 2009, 2010, when interest rates came down. I'm going to wait for this to happen again. And you're going to get that. That's a reasonable objection for a consumer. It's a reasonable objection. What happened here during this bump in prices, and look at this nice stable growth of home prices until we got to this unhealthy growth an unhealthy rate of growth because of an increase in demand related to easy money, right? We were giving loans to people that shouldn't have been getting loans. And all those people that shouldn't have been getting loans, they gave all their houses right back and home prices went down. But during that time period, there still were well-qualified folks that continued to buy homes in a sustainable and healthy way. And look at the trajectory. Even when the home prices went down, they went right back to the normal expected projection of growth, right? They didn't bottom out. And right around here, when prices were crashing, the federal government introduced a bunch of new laws for our industry that said you have to qualify people for mortgages, the QM rules, which are pain for all of us, all right? But it's necessary as it is a seatbelt to keep us all safe. We have to look at their pay stubs, their W-2s, their tax returns. We have to average their overtime. They need a certain amount of time on job, et cetera, et cetera. What that means today is that mortgage quality, mortgage-backed security quality is at an all-time high in America. They're safer than they've ever been, which means that this dramatic jump up in price growth that we've seen recently is healthy growth. This isn't because of funky, weird loans for people that can't afford them. This is well-qualified buyers that are buying homes because interest rates are at 2%. There's not anything on the horizon that would create a dump of supply on the market like happened back here. If anything, this 2% rate environment has created a long-term, decades-long shortage of housing supply because they don't want to sell their homes, which is the opposite of this problem, which means that this new trajectory looks pretty sustainable at this point. 2% interest rates, 8% interest rates. Did prices bottom out? Nope, they're still looking pretty stable. I want to look at the shape of these two graphs, and we're about done here, okay? I know we're about out of time. I want you to look at the shape of these two graphs. These both go all the way back to 1964. Since 1964, the rate of home price appreciation, this is home prices in America, this is inflation in America. They have a very similar trajectory, do they not? Historically, home price appreciation just outpaces the rate of inflation in America because inflation makes everything more expensive and there are more Americans every single year than there was the year before, and we historically underbuild homes based on the need in America. The trajectory on both of these graphs is similar. Look at this most recent unhealthy increase, right? That trajectory is still similar. But as the stacking of prices gets higher over time, Coke has never been a nickel since. And home prices are not coming back down to this price either. It's not how it works. And so this is important to teach our consumer base, to teach our communities, our people, the families that we love and that we serve. This is important because it comes down to you can buy it now or you can pay more later. That's really what it comes down to. However, when you are talking to a family and you're teaching them these things, which hopefully you will, you have to say it with some bedside manner. Say it with a little bit of love and empathy in your heart because it's a hard thing to understand. It's a painful thing to do, but this is the cold, hard truth, is that if you want to get your family off the street and into a house where you can watch inflation push the price of your asset higher, if you want to harness this for yourself, you need to get off your butt and move. Because right now, higher interest rates could be your best friend. Because as soon as those rates come down, the prices will go up, right?
I was going to say the strength of the mortgage-backed securities, is that heavily because of the, was it Dodd-Frank?
Yeah.
Legislation that went through?
Yeah, a lot of the Dodd-Frank stuff. And there's a whole slew of new rules in the mortgage and real estate industry, which acted as a seatbelt for us to keep us safe. Right? So now we have to qualify people, we have to do this, all a bunch of additional disclosures. But yes, I mean, it's a hassle, but it keeps us safe. And what it has done is it increased the mortgage quality in America, so MBSs are safer than they have been for a very, very long time. So back when they were labeled toxic assets, we're not going back to that again because we saw that allowing the creation of these toxic assets almost crashed the entire world economy. So not happening again. Chris? Oh, sorry, yeah.
One follow-up, so what that's an indication of is, like, notice the default's going to stay low because of that strength.
Bingo.
And all
Bingo. Yeah, notice of defaults are going to stay low. On that note, during COVID, we went into for like a forbearance, right? Forbearance on your mortgages. So you could say, hey, I lost my job, whatever. I can't afford to pay my mortgage. And so there's a bunch of people that swore that we were going to get a dump of supply. They swore that we were going to get dump of supply as everyone went into foreclosure when forbearance ended, right? As soon as forbearance ends, we'll see what the real health looks like. Well, what happened is that came and went, and guess what? There was not a dump of supply. Because all of those homeowners, their homes had gone up in value by $100,000 because of COVID. And so if they were struggling, all they had to do was put their home up for sale. You guys would sell it in a weekend for $100,000 over asking price. Cool, they're good, man, they're good. It didn't hurt them at all, right? So even that, like if there was gonna be anything in the world that was gonna create another dump of supply, it would have been that. It didn't hurt us at all. If anything, that little bit of additional supply that we got was good for us. We needed more homes to sell. We needed more homes. It was unhealthy, right? So there is nothing on the horizon with MBS quality, default rates at an all-time low, and with home price appreciation, huge equity positions. Homeowners today have more equity than they ever have in the history of America. And 26% right now of all real estate transactions in the nation are done in cash. 26% of all of the transactions are cash, which is nuts, which means there's a lot of money. That's what that means to me. There's a lot of money out there, right? There's a bunch of people in this room, and how many of us could afford to buy a property in cash today? No, it's not me, okay, it's not me, but not many of us could. And so it means that it's skewed. There's some people out there who's got a lot of money, just kind of crazy.
And wouldn't you say it's safe to assume that like most of these adjustments are consumer behavior or psychological changes that are required, meaning like, let's just use this year, 100% growth in supply, you know what I mean, in most places from January to January, that is a big change. It's not really reflective to the actual market condition, but psychologically to a lot of people, whether buyer or seller, just, hey, we haven't been in this position where there's actually 4 other homes.
I got options. Yeah. Which feels good. That's healthy and normal. Right. I like that you bring up the word psychology because all of it is psychological. The spread is psychological. Right. The yield on the 10-year treasury is psychological. The way that the Federal Reserve manages our economy is psychological. They're all people, right? They're all using their feelings. They're using the communal cries of America of what we see, what we want to see, what we expect, right? All of it is psychological. Just go turn on the internet. Have you seen any psychological or emotions recently? Man, like, it's a weird world out there these days, and it's all psychological. Absolutely. Also, let's talk about the statement of 100% increase in supply. Because, yes, that's true and accurate. And depending on what data you're looking at, you might draw the wrong conclusion from that fact. That is an accurate statement. It is a fact. It's true. However, if you take that to believe that you have more powerful in a meaningful way as a buyer, you don't. We went from all-time historical lows, and now we've got more than that. But it's not healthy. It's not a normal amount of supply. I went from 1 home option to 4. 4 is not good. We should have like 40. That we could look at. And so we could have a bunch more supply. We could have another 100% and another 100%, another 100% growth in supply to get back to what is a healthy dynamic between buyers and sellers. And there ain't nothing on the horizon that's gonna bring that additional supply. We historically underbuild homes in America. We always have, going all the way back like many, many, many decades, we don't build enough homes. And we largely stopped building homes almost entirely during 2020, 2021, right? We're back to a little bit of building, a little bit of growth now, but it's not enough to get prices down, right? Okay, I know we're over, and I appreciate your indulgence. Questions?
With that building homes, I've heard this number thrown around. I don't know the accuracy of it. I've heard we're about a million homes short for the number of families we have.
Yeah, I've seen different stats, and most of them are more than that. I'd say we're at least a million short. And that number is getting bigger every year.
So if we were to build 1 million homes overnight, it balanced the market.
Yeah, if you could snap your fingers and you could get another 1 million homes, it would help stabilize prices. But even then wouldn't cause prices to go down. It would just give some people some options, which is good for families.
Well, that's similar to the previous gap, that the further you go, the wider it gets.
Ding, 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 ding.
So,
Yeah, the longer the genie is out of the bottle, the bigger and the stronger and more powerful he gets, and the harder it is to shove him back in there.
yeah.
Which is why we, I'm not trying to be like morbid here at the end, but we need some economic pain. We need that shark to start taking chunks out of our economy. It's what we need. We need some blood in the water. We need Doge to fire everybody else.
Well,
Exactly.
it's gonna be, as we're talking through this, it's really good perspective, because I've been doing this a decade now. It's like I had clients like buying and selling like every year. I had clients buy and sell 4 months later and make 200 grand.
Yeah.
Which is just like insane.
Yeah.
Insane. But I think what this is gonna, we do need some pain. We do need some stability. Where like people are living in their houses like 7 to 10 years.
Yeah.
And I wonder like the trickle down effect, like 30 years from now, people who do have those like 2% interest rates, like if the cash buyers go up. Because like
Yeah.
for 25% now, 30 years from now, if all those people have held onto their houses, they've realized this appreciation, they've paid minimal interest, and now there's more cash buyers in 3 decades.
Yeah, it easily could be. Whole different presentation, different slide deck, but what you're getting into there is, I would argue that even if you had all that money, it's not a good idea to buy your properties in cash, because you are missing out on the thing that makes real estate the most powerful investment of all, which is the power of leverage, right? And so real estate allows you to use other people's money to grow your own wealth. And so I mentioned that flip property that me and my partners are doing, right? Are we paying cash for that property? Hell no, we're leveraging it to the hilt. Are we paying a higher interest rate on the mortgage and the rehab costs? Yeah, it's way higher than a normal mortgage. Stoked to pay it because I'm getting to use someone else's money to make me a rate of return that's greater than what I'm borrowing it from. We started talking a little bit about the banks and how the banks make money. What they call that is arbitrage. You borrow at one rate and invest at a higher rate. Right? The banks borrow your money that's in your savings account. They give you 0.25% in interest and a free toaster if you open a new account.
That's right.
All right?
Can you maybe tell a story, because you're very good at it, around credit card debt, okay, like credit card debt, and like delinquency on 30-day, like the rise of those things that are happening, and how that plays into the real truth and affordability, whether rates change or not.
Sure, absolutely. So that recession shark that we saw, that is another looming giant shadow of a predator in the water. Credit card debt, decreased savings rate. There's a whole bunch of other economic factors that you could look at and measure that show increasing weakness in our economy and us pushing closer and closer towards that recession. So increased credit card debt has skyrocketed. The delinquency, the 30-day late rate of credit cards has increased. If you look at the savings rate, I've never seen higher in the history of the country than right during COVID. The savings rate spiked to an all-time high because the federal government was literally just paying us all to stay home, and we were sitting on our hands wondering if we were going to live, saving money. And so during COVID, the amount of money that Americans have in the banking system swole, right? And now we've been watching it dwindle down. And so the savings rate has been going lower, and the total volume of money that Americans have has been going lower, right in step with credit card debt going higher, right? So you could watch in live time the loading bar of the American recession that's about to hit us.
I guess my curiosity, though, is this is something I don't know. In these previous recessions, were we at this point in credit card debt and other things of the such that literally wasn't really what we were trying to solve? We were trying to solve people stop spending money. But back to like the psychological aspect of it is, if you follow somebody in pre-COVID, there were 7 million brain scans on what they would consider 44% of people had a healthy brain activity, meaning not too hyperactive, not too. Only 13% of people now have a healthy brain, meaning more addictive behavior, OCC type thing. So some of this is like, what if they can't change?
Sure, yeah, or just the stress. I mean, if you look at psychology, we are animals, whether we want to or not. There's a lot of brain chemistry that goes on. I've got an Aura ring on. I see a couple of you guys like wearing those kind of things that track your biometrics. And it measures your biological, physiological stress. You can tell whether you're stressed out, but your heart rate, your body temperature. I just sleep last night. Those are all brain scans. You can measure that. And so I don't know exactly, but I think that the conclusions that we can draw is that if you've lost your job, if you are spending your savings, if you are feeling threatened in any way, that you feel less safe. And as you feel less safe, your physiology changes and potentially gets to the point where your back is against the wall and then your brain scan is no longer normal, right? So I think you can see the fear gripping our nation. But if you took that same person who has an unhealthy brain scan today, I would like to think and imagine that if you fixed their economic problems, if you got them into a house, if they felt stable in their job, if they got 6 months of savings back in the bank, I bet you that their biology changes back to that of a more healthy individual, as opposed to a scared junkyard dog, which is where many of us are headed in America.
I think that's why it's so important for all of us to have prioritize personal growth, because you are also influencing your clients and having conversations with them that's more than just buying a house. You're dealing with emotions and whatever their mental state is at, and if you have a healthy mental state, I feel like that pulls them out of it, where they become more confident to buy.
Yeah, you got to focus on yourself, your own mindset. And I started with saying that we tend to be scared of things that we can't see or don't understand. And so if you are feeling all of those things, but you don't know where the external pressure is coming from, you don't know what the bad guy is, then you're more scared. And so what I'm trying to accomplish here, and what I hope that we can accomplish together in the community, is to help people understand some of the forces that are at play. And understanding allows you to better predict that there will be an end in sight. And even better than that, I can learn about these forces and use them to my benefit. Inflation sucks unless you own a bunch of properties, in which case, go inflation, right? If I own a property, an investment property, a second home, if I own Apple stock, if I own Bitcoin, if I own gold, if I own a dump truck, if I own a business, if I own those kind of assets, then inflation is making me rich at a rate of 6, 7, 8, 9, 10% a year. Go inflation. We have to help the people make the jump from the have-nots into the haves so they can ride that wave of economic success.
How do you best explain that to the first-time home buyer? Hey, I really need 3 bedrooms, I just can't afford it. So I've got to figure that out. I'm just going to save for another year and try a higher down payment. Do you look at their income trajectory or their job? Do you look at, hey, downsize, here's your equity position, trade up? How do you typically approach that?
With empathy, with caring, with love and kindness, you say this: buy now or pay more later. And really, you shouldn't say it like that. What you should do is steal my graphs, okay? Chris has got them. Chris has already got them. Download it on his computer. Take them, swipe them, steal them, okay? You could delete my logo and slap your own on there. Shamelessly take all of it and help us get it into the world. Teach them things, show them the graphs, understand how they feel, understand that their brain scan has gone from healthy to less than, right? And then let's turn on the lights in the closet, show them that it's not a monster in there. It's just a pile of dirty clothes called inflation, and we can learn how to use it to our benefit. And if you teach them with kindness in your voice, that if a 3 bedroom is what you need, you can keep on saving and you'll never get there. Buy a condo. Buy something today. Even if you're going to buy a condo and not live in it, buy a condo, rent it out, put it on Airbnb, but get yourself into a situation where you can ride that inflation higher. Buy something to get yourself into that zone and then sell it in 3 years, in 5 years, or better yet, don't. Just scoop out that equity. As the home prices go up, home prices are going up, right? Home prices are going up. So give it a few years of growing, plant some seeds today, watch your seeds grow, harvest the fruit, buy another property, another property, another property. But you got to start today. The worst thing you could do is wait. Real estate is a get rich slowly game. This will make you rich. I didn't say maybe. I said it will make you rich if you own real estate. Real estate has been the greatest economic driver of personal wealth in the history of mankind. And I'm not overstating that. The only way to lose is by not playing the game. And waiting is the worst possible thing you can do because prices are just going to go up.
That's what the presentation needs to be.
Yeah.
It's the worst thing you can do because that's like what technically 80% of people are doing is waiting.
Waiting.
How this impacts your wealth building.
Back to yesterday, right? This is the 4-slide presentation to that person buying cash when we're talking about Zillow home loan transfer rate, right? Is like, hey, are you open to looking at this in a different way or perspective that some other people who have accumulated more wealth have?
Yeah.
Sure, maybe, and now show them the benefit of what he was sharing around maybe not using cash.
Yeah, absolutely. So think about it this way. In 2019, you were working with buyers and you had options and you were shopping and rates were low and it was fun. And then COVID happened, shelter in place, we're all gonna die, I don't know if I'll have a job tomorrow. And your buyers in December of 2019 said, hey, just give me a couple months. Let's take a break. I wanna buy a home and you're my person, give me a couple months. Well, then they started looking when rates, rates were getting crazy, the market was getting crazy. I made 10 offers and none of them got accepted and prices went up. And then they're still waiting to buy, they're still waiting to buy, they're still waiting to buy, they're still waiting to buy. And so if you don't take the opportunity to buy now, what's gonna happen when the recession comes and when rates go down, I predict that we're gonna have another big leg up in prices right here. It's gonna happen again because demand will explode when rates come down and prices are gonna shoot another leg higher. And so there's a strong chance that the buyer that was waiting at the end of 2019 will still be waiting at the end of 2026. And that's demoralizing because they've missed all of this growth of that asset, right? I'd love to come back again. We'll talk more about leverage and some other things of like how you can use the power of a mortgage to create wealth in your own life. It's a powerful force. It's pretty cool. Cool. Oh, we'll do it. Yeah. I know that we're way over time and I want to be respectful of your day. So, yeah.
I keep asking those kinds of questions. I kind of geek out on.
Yeah, me too. I appreciate you being curious, man. I appreciate it.
Let me see if there's any questions out there, guys? Diane, Christina, David, Candace? No, they're still there.
You guys can reserve the right to ask questions later, all right? Please do steal the graphs and use them and put together a presentation. I would be curious to see, down the road, not now, but what you guys got the most value out of. I'd love to help you come up with a way to make this more digestible for your clients, right? So help me help you, and let's build a presentation together that you could use for buyers and sellers.
Seems like there's two kinds of ways that need to get tweaked. One is to that first-time home buyer. One is to that person who owns a home would be a first-time home seller looking to trade out.
Okay.
Waiting and trying to figure things out.
Sure.
I think it's a very different presentation.
Yeah, it absolutely is.
Absolutely
Yeah.
is.
Cool. Again, thanks, guys.
Yeah, thank you so much.
We'll hang around.
Yeah, thank
Yep.
you, man. That was amazing.
Oh.
That was fantastic.
Good. Glad you liked it.
Yeah. Awesome. Well, thank you, guys. Have a great day. Call me if you need me.